right, Kyle, you ready?
Yep.
Good deal. Investors, welcome back to the channel. My name is Ari Gutman, and I am here this week with none other than Kyle, the passive income investor. I am sure you've been on his channel before, checking out all the dividend stock and stock ideas that he's got going on. Of course, I got to try to match his energy, but I'm excited to have him on because he's always talking about passive income opportunities, especially within the stock market. He has quite a history. But Kyle, I want to throw it over to you and allow you to introduce yourself here because you shared with me that you were a magician before you got into investing and onto YouTube. I want to hear a little bit about that and how exactly you made this pivot onto YouTube and into passive income investing.
Yeah, thanks for having me on, Ari. And yeah, it's kind of a pitch up to like the old days of how I used to live in the entertainment industry for 10 years. But the whole thing was I was a full-time magician from the time I was like 16 till basically the pandemic hit when I watched like all my contracts dry up within a week. But I was always pretty privy to the idea of investing because when you're self-employed, especially here in Canada, you don't get unemployment benefits. So I started investing super early on just to try and protect myself because you're only as good as your next gig. And I was very blessed that the career always just had more going down the road. I was working with my business partner that ran a DJ company. We do weddings, fly around. I did some really fun events for like even stock twits before the pandemic, which was super cool. But investing super early on, man, I was very blessed that I always said the best period in the market was from like about 2010, 2012, all the way up till about 2020 because everything was so consistent. I mean, you could have threw a dart at a board and have made money. Everyone seemed probably a lot smarter than they were. And I got like my footing, luckily, in the MJ markets before legalization, which I mean, it's kind of crazy because Canopy was the first stock that I ever bought and it's trading for like 50 cents. It's below where I was buying it initially for like where I think it was between $2 and $3 a share back in 2016, 2017 time period. But they're always like, buy what you kind of know, right? And I was like, well, they're going to legalize it in 2018. And it seems like an easy home runner if we just buy the biggest MJ company that's currently publicly traded. So I put a bit of money in. My mom, I think I put like 3 or 5,000. My mom ended up buying a bunch of it too. And this was like, I had no one to talk to with investing. So my mom and myself would always go back and forth on it. My mom kind of introduced me to the markets after I started my business. And I was like, it's so hard to start a business. And it took me years to pay off the debt that I took out and I'll never do that again. But she's like, you should look at the market. You can own companies just by putting, money in them and you don't have to really do anything after the fact. And I fell in love after that. But 2018 hit, man, and Canopy ran up to like 25, 30 a share. I started selling it. My mom rode it all the way to 50, took crazy profits out of it. And then basically from there, I was hooked. But again, I was glad that I was more in the individual stock game because I was buying Apple back then, a lot of foundational companies, a lot of the Canadian banks. And yeah, it was just easy money, right? It just felt like consistent easiness up till the pandemic, and now it's a different ball game because now we have the technological revolution going on, which I don't think people understand how complex that the complexity that adds to the consistency of every business. As we talk about like with McDonald's, I mean, you look at a company like McDonald's, right? And they haven't been able to grow revenues for years. So how does their stock go up? How do they continue to maintain, right? It's like gross profit. Like they're constantly increasing their margins and they're doing it through innovation, right? They're getting rid of the front desk. They're making it so there's touchpads everywhere. Eventually AI is going to be running their drive through, eventually robotics, which I don't know why they're not running the, if I worked at McDonald's for 2 years, so I kind of got the gist of it, but there's no reason for staff to be there for like at least 80% of the work that's going on. So it's just every company's going through that technological shift, and you can see ones that are struggling to almost survive in that. But it also makes the market a lot more complex than it was from the 80s, 90s, 2000s, because there's just no consistency, right? Everybody has to evolve. Whereas before, you could have just been a General Electric and you'd been fine for like 30 years because nothing was changing so much. But every business is about to go through a technological jump. So yeah, I don't know. I'm more privy to the index funds these days, I would say, than a whole lot of individual stocks.
So straying away now from individual stocks and into indexes, ETFs. I like it. I want to go back really quickly to how you started off because first of all, what a risk to take, I feel like, investing into all the marijuana plays. And I remember at that point in time, early 2010 and on to 2020, that period where there were a lot of investors looking for the next big play when it came to all the marijuana picks. And I did not get into them. I have to be honest. I was too risk adverse at that point in time. I started off with index investing, playing it a little bit safer. Now, you made a lump sum of money, I'm assuming, there after that $3,000 to $5,000 investment. How much did you return on that?
Probably like 25, 30 grand. Typically I wish I was a little bit more risk on because I I've always been very hesitant to put like a crap load of money into any individual stock, like the Dogecoin millionaire. Like I could never do that. But I was always really good at risk mitigation because anytime these stocks would run up, I was constantly taking profit all the way up until I always thought things got overbought, and then I would just probably liquidate it. And that's always worked to my favor. It's kind of like Kevin O'Leary says, right? Like no more than 5% in any individual investment. I think the max I would go maybe be like 10%. But yeah, 30 grand. And then I just kept diversifying it. I always take profit down. And I just did that with every company that I'd hit with. Not all of them went to the moon. I mean, I made huge mistakes with things like GEO Group early on, that prison stock that Michael Burry loves. I got on Netflix. There's a Netflix documentary that I'm in that does not make me look too good for me buying that stock. But there's that one. I mean, like I said, not everything was a win, but the wins that I had were just astounding. Like Apple did so well. I got into Tesla in 2019. I don't hold that position anymore. Made crazy good profit on that. That was like another 25 or 30 grand. MindMed was a favorite of mine that I still, just for nostalgia reasons, hold a little bit in. The psychedelic days were really interesting, so I did very well on that one. But now the problem is like we were saying before we went onto the stream, was I just don't think there's consistency anymore in the market. 2020 just was out of control because the Fed printed too much money, and that led everything to doing well. Whereas when you go back before 2020, things were doing well because the market was just sustainable, right? I mean, growth was there. People weren't printing money like crazy. Yeah, the interest rates were low, but it was just a market that was very prosperous. And you saw it in all the earnings from Amazon and Apple. Like we're talking about double-digit growth year over year over year consistently for, like, it was the greatest growth period pretty much in the entire stock market's history, right? And now it's just that I don't trust anything because there's no trajectory for that right now. I mean, Apple's had 3 consecutive quarters of negative revenue growth, yet the stock's gone up. Like I can't work my mind around that. Look at Nvidia. Nvidia was the biggest pump to this last earnings, and this last earnings kind of justified the value. But you couldn't say that last quarter or the quarter before because they were losing revenues. And it just didn't make any sense. It's like, why are people buying this? It's overpumped. It's garbage here. It's a bubble. But now all of a sudden these earnings were so good that it's like, it's expensive, but they're kind of justifying this expensive value until those revenues start to fall off again. So I mean, you can't, it's like a who's game. Like there's no projection anymore. It's like, I don't know what any of these mega cap companies are doing tomorrow. So I can't buy them and hold them consciously being like, this is an easy money game anymore. It's like, so that's why I kind of pivoted more into index funds. I did that at the beginning of, I think, the first quarter of 2022. My fiance's got a little bit more fortitude than I have because I sold pretty much all my tech stocks and just threw them into index funds. And the reason that I go into index funds is because they auto weight it for me, right? I don't have to play the game of who's the better company. The index just auto weights based off market cap, right? So the better companies make their way to the top, and then I get exposure to Nvidia and I get a bigger weighting when it does well. Whereas I don't have to play that guessing game. My fiance, she managed to hold through all of this. She's got more fortitude than I'll ever have. I mean, she held Meta all the way down to 90, and now she's up like dramatically on it. She's one of those buy and hold forever, whereas I'm a little bit more in and out of it a lot, but she holds great companies. She's not like buying trash companies, so she's comfortable holding them. Whereas when I'm buying speculative things, like, again, I think Tesla's a good long, but when these companies run up 500, 1,000%, those are like unicorns that they're rarities, right? So I don't know why people hold them. When you make that much money in a given year, my rule of thumb is if it goes up 100% in a year, you take your profit out. You can gamble and speculate with the hedge money, but the Dogecoin millionaire didn't learn that, right? He should be a valued lesson of like what not to do when you're holding things you don't truly understand.
Hey, talk about the magic of money. I think you have it though, because you profited a whole heck of a lot. I also got to ask, at least eventually, what your dinner conversations are with your fiance, just based on the fact of how you two invest, when to sell, when not to sell, when to hold, when to buy. I want to ask you though, when exactly did you become the passive income investor, right? Kyle, the passive income investor. Can you talk to us a little bit about the passive income aspect of your portfolio?
So I think people associate passive income too much with dividends. And I'm glad that I was buying some growth companies because I think people kind of get into this fallacy that they think, dividends are the end all be all. And it's nice watching the dividend snowball grow and all that stuff. But if you're younger, the mistake is giving up the growth vector of the portfolio, because it used to mean a lot more to me. I was very yield focused, specifically in Canada, because Canada is a little bit more reliable for higher yields. Our bigger companies pay a lot more than they do in the US. It's a little bit more tax efficient that way. But the problem is I just don't think people need that income right away. And they've given up so much growth over the last decade, depending. Again, Pepsi, there's some good Procter & Gamble, like really boring, great dividend companies that have grown very nicely, like even McDonald's. I mean, there's some good growth companies you can get there, but I would have felt like I know guys that regret it a lot that they spent the last 7 years just buying dividend companies because they knew the value that there was for growth, and they never needed those dividends for the last 7 years. Passive income doesn't purely have to come from these option ETFs and all these things these dividend guys talk about, right? So I've always focused on both. Because again, like if you can get a good gain on Facebook, you can liquidate it down and put it in dividend companies, and that growth rate would have been exponentially higher to your dividend growth than you just putting it in some slower growing company that only grows at 5 or 10% a year, right? From a revenue standpoint, whereas, you know, Meta and these companies that have been growing at a 20% clip. I mean, Apple's a great example, right? Apple's a dividend payer, but people are like, no, it's not. It pays like what, a half a point? Like no one cared, right?
53% yield, I think, something like that.
The crazy thing was when I bought Apple initially, I can't remember the exact year on it. I sold all of it at the first quarter of 2022, but my yield on cost was on Apple was 5%. Which when I was showing people that in my accounts, they were like, their minds were blown that that was even a possibility. And that wasn't even that long ago, right? But again, I don't think people should focus purely because passive income is just you not putting the work in, right? And the stock market's the only thing you can really do to get that. I mean, at the end of the day, like YouTube's not passive. Most jobs you're working, they'll never be passive. Real estate's not passive. I mean, I know very few people that get in a circumstance where they have enough wealth in real estate that they can hire management. They can completely take their back off. But I don't know anyone that's been able to not have to put the effort into real estate. Like even if you buy rental properties, even if you have management, there's just always something that's involved with it. I know guys that just retired. There's a YouTube channel called Hidden Freedom. He owned a bunch of real estate. He hated it. He sold all of it to put it in the stock market. I think the stock market is the truest, purest form of, you know, anybody can get into it. It's very low cost. Especially these days with like commission-free trading, and you can just, you know, you can start by putting 50, 100 bucks away in a week or a month, and it just kind of gets you a feel out for it. And you can see the dividends coming in. You can see some of the growth over time, and growth and dividends to me are both passive, right? It's just a matter of you're not doing work for them, working for you. So, but 2019, man, I started my YouTube channel in 2019 after I made my first 100,000. And I had no one to talk to except for my mother, and I felt very isolated because none of my friends were into it. So I just started the YouTube channel because I was just bored and I just wanted to talk to other people about it. And it worked to my favor because now it's basically my full-time gig. I'm kind of just in the YouTube sphere between my channel and the other work that I do that's related, right? But yeah.
Look, I have to say, when I came across your channel, right, I was amazed by just the energy that comes through the screen when I'm watching it. It hooks me right away. And so, you know, I've been watching your channel for quite some time. I've been tracking, you know, your investments, what you've been investing into, what you've been talking about. And I want to know directly from you. First of all, I'll put you on the hot seat just before I go to this next question. Kyle, what is at this point in time the total value of your portfolio?
Between me and my fiance, I don't talk about her stuff as much, but the thing is we liquidated a huge portion of our stocks because we just bought a piece of real estate here in Toronto, which was, again, rather expensive to say the least. But I mean, if I had to liquidate like everything, like all valued stuff, I mean, it'd be probably between 750 and 800,000 CAD, probably closer to what, 600,000 US maybe. It's weird because it feels like a lot, but it doesn't at the same time.
Sure.
Because again, it depends on where you live, right? I mean, the thing is I know places you can go and live and you could retire on, you know, a few $100,000 if you don't want to live. Like you go to Thailand or something, right? Or even here in Canada, you go to Alberta, you could probably retire on less than $1 million if you're living in the right neighborhoods. But in Toronto here, it's like, you know, to be a millionaire is to be middle class. So it's like, you know, your standard of living is not the same with $1 million as it would be elsewhere. So I think it's very perspective on net worth, depending on what you're trying to do and achieve. But yeah, I don't know. Can I ask you the same question?
Yeah, absolutely. So I'll share with you. And again, I was a very risk adverse investor, and I actually have still to this day, I feel like I'm super risk adverse. I have money on the side that's set for real estate, all in. And I usually show this on my YouTube channel. I'm around 120,000 within the Vanguard brokerage account that everybody sees. I got the 401ks as well. And then I have this lump sum of an emergency savings, and then another lump sum for my for the to-be real estate portfolio I want to build. But all in, I'm around 180,000. So not quite there at the $500,000 mark. But no, look, I got to tell you, I have plenty of, I think we talked about this just before we jumped on, regrets, mistakes, whatever you want to call them. I think one of them was not taking enough risks. And now I'm talking to a guy like yourself, right? Some magic with money that you jumped in to, I mean, investing into really, you know, the marijuana plays. There was no way I was ever going to do that, but you took the risk, you succeeded there. And what you do that I think is very important, why I love watching your YouTube channel, which by the way, if you're watching this now, you haven't been to Kyle's YouTube channel, check it out right after you're done here with this video. But Kyle jumps in and out of these stocks, right? He's going to buy, he literally is buying low, selling high, and he's taking and walking away with that profit. And I think that's important to do, especially while you're young and you can continue to afford those risks. But I want to ask you what you think the most common mistake is, or at least mistakes that you've made, because you are 30, 31 years old, correct? And you're over $500,000. So clearly you have a recipe for success. And can you share a little bit about that recipe, again, on the angle of the most common mistakes you think investors are making?
Well, I mean, it's kind of not privy to investing as much as it is exactly what you were just saying with the emergency fund and stuff like that. I think the hardest thing for people to do is play within a realm of like financial understanding, especially with how expensive things are. I mean, real estate's a good example, right? Like no more than 30% of your income should go to the mortgage. No more than 50% of your income should go to basic needs. And I think a lot of people don't go into anything thinking like that. I mean, because to us, like we were stuck on this boundary of we're either going to spend $3,300 a month renting or damn near 40,000 a year, which seemed insane because everything skyrocketed so much. Or we're just going to try and take a lump sum with this fortunate amount of money we have and put a huge deposit down. And I mean, we're saving over $1,000 a month from renting. So to us, owning made more sense than renting. But that comes back into the realm of like, you know, playing within these percentages that are like, you know, Dave Ramsey spits out all the time. I think, like I said, there's a lot of mistakes I've made, but again, in the perspective of learning, everyone's going to make mistakes through a lot of different things. But the thing you don't want to make the mistake on is what you said, like not having the emergency fund, you know, paying off a car instead of getting, again, people argue about that, but I don't think car debt, always buy a car with cash. I've done that with every car I've ever owned. And it's been like one of the best things I've ever done. I've never spent more than 10 grand on a car. I think people are always like, oh, Lemon's this, and it might not work for that. I'm like, I've owned several cars in the entertainment industry, driving a lot. I've never had a Lemon. You know, I've always traded them out when they started to get too expensive for repairs. And that alone has saved me an arm and a leg. Again, I had debt. I went through debt early on and I paid that off. It took me 3 years. It was like 25 grand. I'll never do that again. Outside of a mortgage debt, I just think the easiest way to get ahead in life and not the biggest mistake is just financially putting yourself in debt. And that was what I made long before I started investing. So I'm glad I learned that young enough. But like, you know, because if you don't have the emergency fund, people don't realize like I lost my career in 2020. And you know, having that money saved up, that's when I realized the value of an emergency fund. Like you never realize it until it hits you like a bag of bricks and you don't want to have to sell your stocks. Everyone's like, oh, I could just liquidate some stocks. I'm like, the last thing you want to do is liquidate investments because in 2020, did you really want to sell in March? I'm like, I lost everything in March. And I'm like, that is the time you want to start using your investments as an emergency fund. Like, so I mean, just having those things in place so you can always be financially ahead of the game, right? Because I love using the compound calculator. Because in your 20s, you put 500 away a month for 30 years, and you look at what that does at a 10% interest rate vehicle like the S&P, and it becomes exponentially like crazy. If you can get up to 1 to 2,000, that's what it's just, that's the motivation, right? It's like you play with a compound calculator and you just use a simple vehicle, like you're saying with index funds, and you just say, look, like how much can I put away a month in here? What does that look like 10, 20, 30 years from now? And when you start putting away a couple thousand a month, if you can get into that game where you're putting 2,000 away, or you have good months, you got, you know, some self-employment, some side hustles going on, and you get real lucky and you're able to put away maybe even 4,000 a month. Like when you look at what that compounds out to, like I always call it the 10-year prison sentence. I'm like, for the first, you have to give up 10 years of your life if you want to fast track your financial independence. I think everybody actually has to do it, whether you're a student in school. You just have to give up 10 years where you're just going to live without luxury. You're going to live in your parents' basement. You're going to live with a bunch of guys on a couch somewhere. Like, you're just going to give up that 10 years. You're not going to be going out to dinner all the time. And you're just going to just put as much money away as you can, educate yourself, learn, find a business, a career to get into. And if you can get through that decade, the rest of your life is set up. Because that's basically, I've got 2 years left of my prison sentences, as I call it. I started at 23, and I remember vividly saying at 23, I'm going to do this for a decade and see where I end up, because everyone says it takes about 10 to 20 years to become a millionaire. So I'm like, I'm going to give up at least 10 solid years of luxury. I mean, I'm wearing the same suits. I've never bought a new suit. I need new shirts. I mean, I'm getting there, but
looks great, man.
yeah. I'm glad my fiance is in the same boat, because like our dates were like $1.50 hot dog and drink at Costco. I'm like, I just don't think people understand, like, if you can sacrifice that, the rest of your life is going to be unreal. And
Sure.
that's how I kind of feel now, right? Like we've been able to afford this place in an incredibly expensive city. We've been able to make all this stuff work because we've done that. We put that hard work and that time in. It's just, I just don't think a lot of people want to do it. I mean, that's the mistake
Yeah,
right there.
look, I'll tell you, I'll be the first one to say it. My early 20s, especially while I was in college, I like to say I was a super saver, right? And I tried my best. I saved money. I was always working. But there was a part of me that also liked to spend, right? I wanted to enjoy as well. I think there's definitely a delicate balance. However, I also think it's well worth it to put money away, to invest it, to grow it, because you don't want to find yourself in a position, right, when you're looking back and you're like, well, did I need to go on 3 or 4 cruises with friends? Or could I have put that money away and invested it, right, maybe into apples or the marijuana stocks that you did, right? And you're going to end up at the end of the day, that so-called sacrifice really is going to put you forward in life. But I want to know, from your perspective, where do you think you got this just thirst, I want to say, for financial independence and passive income? And because it really is unique to this prison sentence you're talking about. Willingly take the keys to that jail cell and throw them right in your 20s up until your 30s.
So I just want to preface one thing before I talk about the motivation side of it, because the motivation side is probably a little bit more dark, but a little bit more macabre, I guess. But the thing too, I want to state is I don't think people need to give up on like going out and doing things. And I was very blessed to be in the entertainment industry because like I felt on top of the world in my 20s because I was getting paid to go to places people had to pay to be. And a lot of that came with free drinks. I mean, a lot of that came with a lot of travel, and a lot of it was expensed through other people. So I feel extremely blessed to have had that, because it was just a fun way to see a lot of parts of Canada, the US, and not get caught. And I think people can do that. Like if you love if you love going out on Fridays, try and find a way to get into DJing, security, or some kind of business that gives you access to that life where you're not physically paying for it yourself. There's a lot of fun ways to get paid to do things people are going to do, right? That you probably want to do. But from the motivation side of it, man, like my teenage years were a little bit more rough. I saw a lot of bad things growing up in a small town. So when I was a lot younger, I always found, especially in the entertainment industry, because when I started getting into magic, I realized that I could work for tips anywhere. It was a good escape for me. Drugs ran pretty rampant in this small town. One of my best friends that I hung out with for like years, I lived on the guy's couch. He got into a really bad circumstance with a lot of bad people. He ended up taking his own life, hopped in front of a train. I just consistently saw like what things were doing to people, and I just realized very early on that that's not going to be the life that I want to have. So I kind of withheld from it. It ended up giving me a lot of issues later in life. I think at 23, I got hit with a really bad spout of depression because I emotionally buried a lot of the stuff that I went through. I didn't deal with it properly because I was too young to know how to deal with it at 15 and 16 years old. But it gave me that motivation to just kind of get out. And the entertainment industry was like a huge dart for me. Because I just started, doing the magic stuff, and I realized, hey, like people would pay me, like I could make 20 to $50 an hour working for tips. Anywhere there's people, I have a job. So when I was like 16 years old, I called up like 50 restaurants, and my pitch was, I'm going to work for free. You don't have to pay me anything. I'm going to work for tips. No one's obliged to tip me, and I'm going to let them know. And I just started working at like restaurants. I remember I was working at like 13 Boston Pizzas once upon a time. I even got to meet Jim Treliving, the guy that owns it. So he was on Dragon's Den for a little bit. I was so motivated when I was younger just to go anywhere there were people. I used to busk on the streets of Toronto. I'd go down to like the beaches in Wasaga, entertain anywhere. And yeah, it just really pushed me into that. And then I met my business partner through, we had a mutual friendship with my buddy that passed away because he was employing him. So
Sure.
we found some mutual, respect through a lot of that, and we ended up working together. I still know the guy now really well. We're really good friends still, which is nice to still kind of have some connections from back then. But yeah, so I mean, all of that. I mean, I think that's where a lot of motivation for people come from. You just get sick and tired of being in certain circumstances, right? When you get tired of being broke, and you get tired of seeing what poverty and like low income does to people. I mean, it's not a good thing, I don't think, because it's not like, my parents were never like crazy, like wealthy by any metric. We were farmers. I grew up on a sheep farm. So my parents, and farming is not like a high-end industry. I mean, my parents, so we were always running the streets when we were a lot younger. But yeah, I don't know. I just, like I said, I've seen like small towns, low income. There's no opportunity. I mean, you don't see big business coming into these small towns. So I always just hated it. I always just felt like there's a lot more out there. So you kind of just want to fight for it. And you kind of just say, I can get more out of life than this. So you either kind of get sucked into it or you push yourself out of it, I guess. But yeah, different childhood, I guess.
No, look, there's real magic behind it because I mean, everyone has their own individual story. I think life is always constantly unfolding for us, if we allow it to and we don't get in the way. And I think at any given point, we have the opportunity to walk down I want to say, a cleaner path for ourselves. Any day of the week, at any time, we can make a decision. And it just sounds like you made that decision early. What I love about your story is that at such a young age, I mean, you have this prison theory, right? Like you throw the key away. It's going to take about a decade to 20 years worth of time to get wealthy. And that was just it. And the game was on. Was there any books that you were reading at that point in time? Or I'll ask, what was the best investment advice? Because it wasn't just about saving for you, which is something that I think it's so important for young, investors to be, or really just anybody out there. Right? I have a sister who's like a super saver, does not put money in the market, amazing at saving, but losing out on opportunity because she doesn't invest. She's not doing anything with that money, especially, we're talking about inflation for the last few years off the charts. But I share that because it's not just about investing. It's not just about saving. It's about investing and allowing that capital to grow and to work for you. And here you are again, it seems like ahead of the game, doubling down on that. What advice did you take early on from someone? I know you shared a bit about your mom. Was there any books that you read or like an investment hero, if you will?
Back in the day, before we had YouTube, I mean, Financial Education, Jeremy, these guys, Graham Stephan, they weren't around back then, right? So, I mean, I only had forums, and I always grew up in like the more toxic realm of the internet because, I mean, you're close to my age. I mean, it was more of a Wild West days back then, even on YouTube. I mean, StockTwits was around pretty early on. There were some stock forums, but they're very toxic, right? Like I grew up in that toxic realm of the internet when people like racism ran wild. No one cared, right? So I always felt like I had at least had a tough skin for the market just because like there's always an adverse opinion. The problem I had, however, that really annoyed me was that I didn't have that broader perspective earlier on because I was influenced by people that were on BNN here in Canada. Like I remember calling in and talking to Kevin O'Leary on BNN, like, and it was like it made my whole day because he was on. I called in and I was asking him about like Coke and Pepsi, and he's like, oh, Coke's not a good company. He's like, people aren't going to be drinking that much pop in the future. Like just opinions that didn't mean anything. They were really stupid. Coke's been a great company. Will probably continue to be a great company forever. Yeah, I ended up getting sucked into like the Peter Shivs of the world because he was very popular back then. And actually, my biggest investments back then were actually precious metals. I mean, I had over 30 grand sitting in the basement in a pile of like metals that was just, it was stupid. It was so dumb. And like taking those opinions early on, like really held me back a bit. However, I remember the day when I took those precious metals. Actually, my first YouTube video, if you go to my channel in 2019, my first channel was me liquidating all of that gold and silver. And I remember the guy that used to sell it to me because there's a huge bullion shop here in the city. And that's the one that I was going to. And when I brought all these metals in, I said I wanted to sell them all. The guy's face was just catastrophic because he's been selling them to me for like 2 years, right? And he's like, I can't believe you're doing this. But guess what I did with that money? A huge portion of that went into Tesla stock. So in 2019, when I started the channel and I liquidated all those metals, most of it went into Tesla stock. So wow. I made like exponential returns. I don't feel bad about it, to say the least. But I feel like I think for most people, what they need to do and is to just like you said, it's not about just saving, it's about investing. But I don't think it matters how you go about doing it, but just investing and just diversifying and getting your roots set up, I think is the only important lesson that everyone can like just start doing. Because you're never going to make the same, like I can't go back and give you like a formula that worked for me. There's no way it's going to work in the future. I don't know what's going to work tomorrow. Nobody really does, right? So you kind of got to stick in your realm of understanding, like Buffett says. I always felt like you'll do the best when you stick to what you're comfortable with, and you, like you said, not being influenced by other channels and other people. Sometimes taking those very simple rules, which I didn't really get out of a book, I kind of just, again, listened to Buffett. I just watched these OG guys and I got steered in the wrong direction, but I don't think it was the wrong direction because it got me started. And then eventually I realized that gold and precious metals, which I still own some, but I realized that's not the proponent of the direction I want to go in. And again, looking at the MJ stocks, that made sense for me because I grew up in a small town and that stuff was running rampant. And I understood the value of legalization because back then everybody knew in Canada that it was basically legal anyways. I mean, like over 1 in 3 people were doing those kind of like illegal substances in Canada already. Like it was so popular just growing up. And I'm like, how can I lose money in this? Like, why does nobody recognize what's coming? Like we know there's no way they're gonna bar legalization. They've already stated, they've set a date. Why not just invest in it and just wait and watch what happens, right? And to me, being a young kid and seeing all this illegal stuff, I'm like, this is actually like a legal way to make money off this, where you don't have to feel so gross about, especially when fentanyl and all that started running rampant back then and people were ODing like crazy. I mean, I had some good like moral grounding in it, so it made sense for me, right? And same with like Tesla to me early on just made sense. But I don't think just investing in whatever, the problem today now is, I think if you're newer to the market, again, I'm kind of getting off track because I just think starting investing matters more than anything. You'll learn as you go. But I think now the best thing you can probably do if you want to make better money and not invest just for the long term, and you want to find something you can understand, is trend investing. I think trend investing is more prevalent now than it was when I started, because there's no sense in stocks running like they are. Like I see so many bubbles going on, like Palantir's crazy overvalued. People seem to love it. I think it needs to get back below $10. Doesn't mean it will. And people get pissed when you say that. But what I don't think people recognize is these trends last for 6 to 12 months. I mean, the MJ trend lasted for almost a year. I mean, the Tesla and the EV trend lasted for almost a year. The crypto investment lasted for 6 to 12 months. The thing is because of social media now, and everybody on YouTube wants to make money, they go to where the views are. So everyone starts talking about Palantir. Everyone starts talking about this AI thing, and it lasts for way longer than people anticipate. So you could have bought any of these top leaders in the AI space for the last few months, right? You could have did it with Palantir. You could have done it with, NVIDIA, and you could have just bought a big chunk, and then every 10% it goes up, just take some profit off of it and set some stop losses along the way. I think trend investing is probably more prevalent to make money today than actual like logical investing is, because there's no fundamentals to the market like there used to be. And I just, like I said, I'm not investing like I used to be. So I might try the trend stuff, but I think that's probably easier, maybe, if you can catch it.
No, look, there's a lot of insights. I mean, everything you just shared, and particularly graduating from the University of Hard Knocks, if you will, where you're just going to trial and error. It's like, yes, you can read and you should read books and you should gain more knowledge and do what you need to do. But most importantly is like, jump in, start. And I feel like everybody's always waiting for like, I need $1,000 to start. I need $10,000 to start. I need to find the perfect opportunity to start. First of all, good luck trying to find that perfect opportunity that's going to 10x you, in a couple hours or a couple days, whatever it might be. But I just love what you said. Get started. Don't waste time. Jump in. Learn while you go. Learn as you go. And, to that end, if someone's out there right now with that $1,000, with that $10,000, what would you say is the ideal strategy to go about as an income investor, right? Because you have quite a strategy going for yourself and it works. But what would you say to someone who's perhaps brand new to investing, or even with a year or two of experience, but not seeing that magic in the market?
Oh God, man, I hate that question so much, just because it's so dependent. I always joke about this with a few of my buddies, because there's like a series of questions you almost have to ask yourself, like, what's your age? What's your income? Like, what percentage can you put away? Like, there's so many factors that come into play with like the percentages you should be investing where. Because at this point, I think a lot of people should be cost averaging into index funds, because it's just an easier way to start. It makes more sense today than it did post 2020. But at the same time, like, I don't want you to give up on that risk, because people get pissed when I say this, but valuation doesn't matter if you're 20 years old. If you have $1,000 to invest, go balls to the wall, right? Who cares? I mean, you can invest in Tesla and people can tell you it's overvalued, but you have such a long time horizon. When I was buying Apple, people said the iPhone was done. They said it's peaked, it's over, Apple's overvalued. I've been hearing the same story from Peter Schiff every year since the financial crisis, right? It's just a matter of risk versus age, because when you get into your mid 30s, you start losing that runway for risk, because you can't implode your accounts. Like, the opportunity to lose that money, you can't. You just don't have time to recover, right? And in your 40s, you definitely don't have time to recover. But in your 20s, I mean, you could purely buy overvalued stocks, spend the 5 years doing that, and it won't matter, because by the time you're 30, the value would have had time to catch up. Because Tesla might be overvalued today, but at the current value, it might not be overvalued by the time you're 30. And then when you're 30 years old, oh my God, you're now my age. And Tesla's already, it's now the #1 selling car globally. And, their self-driving is implemented. They're making huge margins off of it. Like, you have so much time for that opportunity to bake into the value of the company, right? So if you have $1,000 and you're 20, I mean, do what I did. I only bought 2 stocks when I was 20. I think one of them was a company called Northland Power. Luckily, I sold out of it because it also tanked like Canopy did. But Canopy and Northland Power, I only owned 2 stocks when I was 23 years old. So I mean, like when you're 20s, you can learn, right? Like you said, like just get into it, start learning, start figuring out what works. You can put a little bit aside, maybe cost average into index funds in your retirement accounts for long term, but take some risk. I mean, do it if you're younger. But again, if you're 30 or in your 40s, $1,000 is obviously not enough. I mean, $1,000 is a good starting point, but it's by God not the end means of kind of getting baking in those fundamentals of just getting used to the habit of investing consistently. But yeah, if there's one thing you'd invest in with $1,000, I don't even know at this point. It's going to be so variable depending on those rules, time horizon, your age, your income, how much can you save? Do you have an emergency fund? Do you have credit card debt? Because obviously investing that $1,000 and paying off debt is going to exponentially give you a higher return than anything you're going to buy in the market. But yeah, I hope that answers some people's questions, and I hope you find your own way at your own age.
Sure. No, all good insights. Now, when it comes to building a portfolio, here's one that I've actually heard a barrage of answers from different types of investors. Specifically, when it comes to dividend investors, we have a lot of investors that think you should perhaps look at the best, 5 to 10. We have other investors that say load up. Jason Fieber is a guy out there I always, mention because he was actually one of the first guys that I had on this chat, Master of the Market. And what he shared was like, just load up your portfolio with every single stock that's at a good valuation, that's safe, that's reliable. Of course, he has his strategy and he went to Thailand and did what he did. But I want to know from your perspective, what is a good amount of holdings to have within our portfolios? Are you the more, 5 to 10 guy, the 20 to 30, 70 plus, like Jason Fieber? Where do you fall?
So it depends on where you caught me, right? Because back in the day, I was all individual stocks, usually about 10%, 5 to 10% of holding. And that only changed in 2022. But like I said, it's variable at this point at the scale of my portfolio, because again, I've evolved over time. I don't want that risk, and I don't want to have to manage it, because I feel like a lot of people like PPCE, and there's a lot of big dividend guys out there. And my problem is when you start buying 40 or 50 stocks, you're basically just buying an index fund at that point. I mean, you could easily buy, because to be truly passive, you have to hand off management at some point. When you hold individual stocks, I know people love the idea of these companies that have been around for 50 or 100 years, and you buy them, you hold them forever. But the fact is things are changing exponentially, and it's really hard to buy a company and presume that it's going to be around in 100 years and you're comfortable with that, right? Like, I think fundamentally, if you own an individual company, you have to manage it to some extent. You have to pay attention to quarterly. You have to keep up on it, because I've held a lot of good companies I thought were ride or die companies. One in Canada, like Algonquin Power and Utility Corp, they clearly mismanaged their debt. That company tanked. I mean, so when you're buying all these individual stocks, I think it's better at my level, where I'm sitting from my perspective, to not make it any more than about 10 to 20%. I don't, and that's pretty much where it's at, because we own a lot of individual tech stocks still between me and my fiance. Like, we hold Apple, Meta. I think Meta is one of our largest positions still. I own a lot of individual Canadian stocks still, but the vast majority of our money is in the S&P 500 and like SCHD and these dividend ETFs, because like I said, you got to manage it right. And at scale, I just don't think buying 40 or 50 stocks makes sense. Because at the end of the day, you're looking for return. Total return matters more than just dividend return. And to maximize total return, you're better off doing what Warren Buffett does and picking 3 to 5 holdings you actually love, that you actually think you understand, and just keeping them at a larger percentage rather than equally weighting 40 or 50 companies. Because that's not going to lead to outperformance. I don't see that ever working. You got to be like Ray Dalio. You got to be like Warren Buffett. They pick a few ETFs. Like Ray Dalio is like what, 2 or 3 ETFs, global market, S&P, and then he upper weights companies like Pepsi and Procter and Gamble, right? I think it's a better way of doing it. But yeah, it's just my perspective, because I've watched so many guys and they just weight so many tech companies, and they think that just buying all these stocks is the way to do it. I'm like, like I did back in the day, like Apple and Microsoft were like my 2 biggest companies. That worked leaps and bounds for my portfolio. And I didn't own all the big tech companies. I didn't have to own Netflix. I didn't need to own all these tech stocks. I just picked 2. And I made them the upper weights in my portfolio. And again, like Buffett, you see those outsized returns from that.
It's funny, man. Again, I'll be the first one to say it, right? Where I made mistakes even in my investment career. And one of them I always look back to is in 2020 when the market tanked. There were a bunch of stocks that just fell. And I was like, wow, that's a great one. That's a good one. I'll take that one. I'll buy that one too. All of a sudden, my portfolio exploded from 5 to 10 to over 40 stocks. I had no idea what was going on. I was seeing, dividend income coming in one month for like 90 cents because I had 3 shares of X company. And I'm like, okay, I got to rework this. I heard then a snippet of Bill Ackman, who's one of my favorite investors, and he shared it. You're going to have the best luck out there in terms of generating a lot of freaking wealth if you are able to nitpick perhaps the best 3 to 5 high quality companies that are out there. It doesn't have to be dividend stocks, but 3 to 5 high quality stocks, and then create a little buffer for yourself with some other stocks that you know are reliable, good stocks to invest into. And since I've done that, I've taken a completely different approach. The returns have been great. Of course, I see different dividend income. I am a dividend investor, but what I don't mind in the slightest is 1 month where I'm not receiving, the $400+ because I'd rather get that on the quarterly. I don't really care whether it's quarterly, monthly. At the end of the day, it's my take home, kind of like you just shared. But to that end, you are a dividend investor to some extent. How much are you making monthly or quarterly when it comes to dividends?
Back in the day, before the mass liquidation event to buy this property, I think we were at like $1,000 a month. Like I was doing pretty good. Obviously, you could expand that dramatically because even with the portfolio we have now, like I mean, we could easily make a ton more. It just like because again, I don't like looking at that. Everyone gets so fascinated by that, and I'd rather look like I always show usually monthly reports on my portfolio performance.
Sure.
Because again, to me, total return matters more. But I think right now we're back down to maybe 500 a month. Give or take. But again, when you look at the fact that we have almost like 30% of our portfolios in the S&P, I mean, again, I'd rather make 500 a month, knowing most of my money's in a broad-based ETF like that, giving me a 10% return. Then as I get closer to retirement, obviously the goal will be to make higher income because I think I've got like 50 or something odd thousand or 60,000 in SCHD. And that one's really nice. But again, that yield's not huge, right? It's 3%. I could take most of that money and just dump it into Canadian banks right now that are yielding up to 6%. And you could double that overnight, right? But again, I'm always trying to play that balancing act because I do like I know I've got 20 years ahead of me. I want to try and get like to a base point of like at least semi-retired by the time I'm 40. But at the same time, like it's not like the end all be all. I'm still going to work. I'm still going to find stuff, enjoyment out of life. So, I mean, I just want to look at it that I got to make sure this is going to extend 20 or 30 years. And, the easiest bet you can make in 20 years is the S&P. So I'd rather, try and get that 10% if it still works out that way. But yeah, again, it's great seeing a 4% dividend, but it's a lot nicer seeing a 10 or 20% gain in your portfolio.
Sure. I couldn't agree more. Look, even as of late, I've taken a completely different strategy, and there's been some moves, I'm about to make, the coming months. Yeah, that is shifting away from a lot of the individual stocks and just pouring money into growth ETFs and even dividend ETFs, but really taking that more passive approach. Because again, as I get more into, looking into real estate or even the stocks in of themselves, I want to pour money into high quality positions. And I want to back away a little bit with this next question and ask you, because you and your fiance do invest, it sounds like quite a bit. I want to ask how important you think it is to find yourself in a relationship with someone who understands money, someone who understands finances, and how does that play a role in your relationship? Because I still feel like today, guaranteed, I can go out in the street, ask people, are they financially on the same page as their partner? And I have a feeling that a lot of people, right? We have the spenders, we have the savers, we have the spenders using the savers' money, right? I feel like the power couples, the people who are in your position over, $500,000 at 30, they're the ones that are coming together at that table, making financial decisions together. How was she when, you met, and how have you guys grown together financially?
So I'll tiptoe around this because she obviously she's a little bit more private than I am this way. But when we met, I didn't have the money. I didn't have any real money. Let's be like, I think when we met, I was 25 years old. I maybe had, if I was lucky, that was probably after the Canopy days. So maybe I had like 50 grand if I was lucky. But she was in between jobs and stuff. Like the only thing I love about our relationship is we were very in a very simple starting place when we met. But she was always a good saver, and she was always very frugal. She's Muslim. She comes from like an Indian household. So she's always like, luckily Indians seem to be very smart with money as it is. But like she was just we're very simple people, which I think really started the foundation of at least a solid relationship. But I mean, she was never into investing. We never even talked about it that much. Basically when the pandemic hit, because she was a good saver and she had a good career, she got into a good job while we were dating, but she had a pretty substantial amount of savings, like your sister, like you were saying, like she saved money, she just never invested it. So when the pandemic hit, because I'm such a stickler for investing, at the third week of March of 2020, I'll never forget this, I reamed her out. I made the meeting at the bank for her to open up an investment account. And she had some investments with RSPs and stuff her work was doing. I mean, she had stuff with her TFSA that her dad's has some manager that was managing it for. So she had the investments going. She just wasn't managing them. She didn't really pay too much attention to it at all. But for a regular account, she had all this money. And I was like, we're going to the bank. We're putting it in this market. Like we're going to go crazy here. Like, so the third week of March, she bought Apple, she bought Facebook. She loaded the boat on a lot of Canadian banks. And even in this correction, she was only down like 10 or 20% on Meta at the bottom. I mean, her average buy price on Meta was like stupid. It was like below 150 a share. I mean, same with like a lot of the stocks she bought, right? So even when the market's down now and these bank stocks are down, she's still up a lot on them because she bought the bottom of the market. So she got super lucky that way. But honestly, it's still a bit of a struggle, right? Because I don't want to control her finances. Like that's not my goal. And I feel like sometimes I overstep my bounds that way because I prefer to she do what I'm doing, but that doesn't mean that's the right thing. So she still holds a lot of her individual investments. Like she gets the idea that we have to put money away monthly. Like she does her own thing with that. And we buy a lot of index funds and stuff, but like we try and segregate it. I think like you don't want to bring your finances together. I don't think that's healthy for a relationship. But I think having the same goals in mind of like knowing where we want to go, putting the same amount of money aside for whatever, paying the mortgage off early, et cetera. Like I think obviously matters more than anything else in a relationship, unfortunately. It's sad, but like they said, like the number one reason divorces happen is probably because of money. And I've dated women that were horrible and I broke up with them because of their finances. Like I dated this chick that wasn't going to college and her dad was loaded and she was going out every day spending money on her dad's credit card, like every day going to like restaurants, every day just mindlessly doing whatever she wanted. And it just morally crushed me as a human being because it just wasn't who I was. I'm like, it's a great life, but it's not my life. Like, I don't want to be supported that way, right? Like, I don't want to rely on this crap. So I think obviously the most important thing to any relationship is money. I mean, it sucks, but it's true. If you don't get that figured out, I mean, and like I said, simple things matter a lot. And I'm glad that we're both simple people. You going to Costco, it's a great day. We go out, don't get me wrong, we live a little better these days. I mean, we go out, not living like that like we used to, but I mean we're still simple people, right?
Not a $1.50 dates anymore. I'll put it that way.
Not
Up
as much.
to five.
Yeah, we go out to nice restaurants now because I take friends out. Like I don't live the prison sentence that I used to be honest, but I'm not living lavish either. But we do go out a lot more often now, and we want to travel and obviously get those experiences. But we've set ourselves up to make it, and we have good jobs. I mean, between us, we make six figures, right? So I mean, that helps a lot too. But getting good jobs. I mean, we don't make crazy money, but that's another problem I feel bad for people is that aren't in relationships and they don't have that luxury, because living on your own and not having that. And again, I never had that in the beginning, right? Like I made most of my money on my own, and now we're combining our incomes, and it definitely changes a lot about fast tracking financial independence. Because you can only do so much as one person, but you get two people working and then you have side hustles, and we both have side hustles. I mean, man, that money adds up.
So I'll kick off with two last questions for you. One's a bit longer. I want to get your perspective on. The second's very quick. It's a fun one. We always end on a high note here, but I'll just start off with sharing, basically where we're at economically speaking, right? We have the Federal Reserve just coming hot off the press, pretty hawkish as of the Jackson Hole meeting that was last week. And we're looking at the remainder of the year in which we're either going to have elevated interest rates, higher interest rates, or something in between there. Inflation is still a little bit high. The market seems to be uncertain. Are you a fan of understanding the macroeconomics? Do you factor in macroeconomics? And if so, or if not, care to explain it, but how you feel the remainder of the year is going to be and how you're planning to invest?
Yeah, so macroeconomics, I do take them into consideration with the stocks I'm buying, because that's why I don't buy like individual stocks or overweight them like I used to, because the macro situation is not what it was, right? When it comes to interest rates, this is a huge speculative debate. Anyone that tells you they know what's going to happen tomorrow is a complete idiot. You can't invest off that knowledge. You just have to consistently buy things you understand. But nonetheless, I still think that inevitably what's going to happen is they are going to start cutting interest rates next year. A lot of people don't think they are. I think we're going to get back to that base. In Canada, it's a lot different than it is perhaps where you are in Israel or even in the US, because Canada has had this massive run up of valuation and everything. It's very expensive to live here now, and people think the entire market's going to crash, and that's where I think they're wrong. I don't think, especially in Canada, I don't think we're going to see the crash people want. I think we could nominalize a bit, but I have a hard time wrapping my head around how bad it's going to be when there's such a supply and demand mess up. In the US, it's the same thing, right? Like real estate's gotten expensive, but there's just not enough homes. There's just not enough things to support the economy and the infrastructure that exists. So, it's great that interest rates are up, but we already have people adjusting to variable rate mortgages. I mean, I looked at the bank earnings. We talked about it on my videos. I mean, 30% are variable, and that the variable rate interest market hasn't crashed. Those people haven't come calamiting down. They haven't defaulted. They're making the payments. So there's some resilience, right? Because the job market's staying strong. So when it comes to what happens for the rest of the year, I have absolutely no idea. I was really expecting the market to hit an all-time high, which was still kind of mind-blowing to me, but I hope it comes down. I'm a guy that always wishes it comes down, but I'm optimistic long-term. It's always going up. Honestly, if the market crashes this year, I'm happy. I would prefer it to crash because that's where we've made most of our money every time. Because we just know that when the market's down, that's when you buy. It's so dumb and it's so illogical. People don't follow that they just, I don't know what it is. We just looked at TD. TD posted their trading volume of like how much active trading is going on within their accounts, and it dropped off dramatically through 2020. And it was like, that was the opportunity, right? And then all of a sudden, now the market's gone back up and you see trading volume go up. Sure. And it's like, it's so dumb that people just don't see that as like, there's a guy in Canada that I watch, and he's very smart about this. He says he just consistently buys every month, but he has his own emergency fund for when the market drops. He says every 10% the market drops, I take from this emergency fund an extra percentage. So I'm over investing when the market's going down, and I just keep buying every month. That way I'm not trying to play the macroeconomic game. I don't care what's going on macroeconomically. It's just, if the market dips to this percentage point, then I start exponentially investing more as it goes down. And I think that's the most sensible way to approach it.
Intelligent. Should be another book. Now I want to ask you, Kyle, the passive income investor, our last question is going to wrap up with putting you back on the hot seat here. Instead of giving you 10,000 virtual dollars right now, because of the man that you are, the magic that you can turn it into, I want to give you 50,000 virtual dollars right now. And if you were to pick just one stock, forget the ETFs, forget the indexes, because I know you're invested in them, what individual stock right now would you put that 50 grand into?
Just based on my ignorance, because I think the real money is going to be made in healthcare. I just can't wrap my head around it. I think eventually in the next 20 or 30 years, healthcare will make up some of the largest factored companies on the S&P top 10, just because, if you can extend life and you can cure cancer, I don't think people always say that cancer, there's more money to be made in treating it. There's not. There's going to be more money into curing it, just like everything else. You come up with a cure to something like COVID. I mean, look at how much money Pfizer made,
Sure.
with, I mean, healthcare, if you can replace organs and you can start doing that stuff, the value of that is going to be, the market cap will be in the trillions. It'll be huge. But if I had to bet on my own knowledge and I was purely speculating, I'd put it in Tesla. Just because the market cap value, and again, if it happens, we're not there yet, but self-driving robotics, if that actually comes into play at scale, I mean, the market cap valuations of those are going to be astronomical. I mean, it's just a matter of, I think it's going to take 10 or 20 years, but right now it's expensive. I'm not buying it now because I'm trying to play it a bit. But if I had 50 grand, I could only buy one stock, I'd probably put it in Tesla if I'm speculating. Apple might be a better, safer play, but if I want to see exponential growth and I'm speculating on that future, I don't know any company that has the future Tesla has if self-driving works out. I mean, who's their competitors? Google, you got Waymo, GM. I don't think they're going to get anywhere near close. They're not investing in the compute power unless they're just renting the cloud storage from like NVIDIA. But Tesla's got the vertical integration, right? Apple's got a lot of vertical integration with some of their stuff too. But that's what you want, man. You want companies that have the biggest. When you want future speculation, you want the biggest potential market caps. And the biggest potential market caps are on the biggest serviceable sectors, which is healthcare. Automotive industry is going to be explosive with self-driving. Automation and robotics, which Tesla's also trying to be a part of, because again, talking about McDonald's, I know a guy that's worth millions of dollars here in Canada, and guess what he does? He makes the machines for self-checkout at Walmart. I bet no one ever thinks of that, right? No, it's like, I want to be a millionaire. I got to make some crazy business. It's like, I got to do some crazy tech startup or some crazy social media business. And this guy's like, I'm just going to make self-checkout machines for Walmart. Boom, multi-millionaire. Like, sometimes it's simpler than you think, right?
But I love it. Keep it simple, investors. But nonetheless, we have Kyle, the passive income investor, with us. here today. Investors, go check out his channel for brand new stock ideas when it comes to passive income, and even just great growth stock ideas to get yourself over that $500,000 hump. I know we're all eagerly working for it. Kyle, I want to thank you personally for joining me today on Masters of the Market. And most importantly here, investors, we will see you all in the next one.
Thanks, Ari. Cheers.